Okay, in this video, I'm going to talk about cash flow forecasting in particular. Okay, let's discuss the importance of cash flow for the business, how actual cash flow forecast looks like, how it's constructed and changed. We're going to talk about the consequences of the failure to forecast the cash flow properly, which may lead to the running short of cash. And how do we actually overcome these kind of problems? Okay, now let's first of all look at two things. When we talk about cash flow, we always do mean two things. The first one, the elements of the cash flow, the first element is inflow, and the second element is outflow. Now, what is cash inflow? I think it's intuitively kind of clear. So it's a cash that is coming from the sales of your products or services. So you may actually have provided the product or service before this month in the past, but your clients haven't paid you yet, and they eventually paid this month. This is called payment by debtor. So historically, if your client has taken your product or service but hasn't paid yet and eventually has got paid today or this month, then this is going to be called payment by a debtor. Now, cash flow, interestingly, can also be a borrowing. So if you borrow some money from external sources, then this is going to be considered also in a cash flow. If you do sell assets, as we said before, it's a one source of financing and you do sell it for cash, then obviously this needs to be seen, okay, and reflected on your cash flow. So, and also if investor invests some money by putting some extra cash, then this is going to also be reflected in your cash flow. Now, let's talk about outflow. Outflow is something that you pay to other parties. So if you do purchase some material or from your suppliers to produce your product or just inventory, okay, then obviously this is going to be outflow. So this is going to be expenditure. Paying wages, obviously it's an outflow, and other expenditures made by cash is going to be reflected in your outflow. Purchasing fixed assets can also be an outflow. Repaying the loan, so you borrowed money previously from somebody and you actually paid out to this particular company, then this is going to be repaying the loan. Paying the creditor, the supplier, is also an outflow. Okay, now if we think about how cash is actually circulated in our business, then you need the cash to keep up your business, to run your business, okay, to operationally sustain your business. So you may want to buy some materials, you will actually need to pay some wages and salaries and rent for your place. Then this actually results the produced and finished good or service, then this eventually sold to the clients, and then the clients actually pay. You do receive the payment from your clients, and then the cash actually comes in again. So hopefully the difference between inflow and outflow, if it's positive, then that means that you're doing well. If the inflow of cash is greater than the outflow of the cash, then that means that your balance is good and your cash is positive. The net cash flow is positive. Okay, let's take a look at a particular case. Now, it's given that the sales of goods, so so you've produced something and then you had a deal with your client and then you have actually sold some product or good which worth $45,000, okay? But the creditor, the client in this particular case, he said, well, we actually don't have enough money. Can we pay $22,500 now, which is 50%, and then the rest 50% next month? You said, okay. We also know that in order to produce this particular product, you will actually need to purchase some materials and pay something which was equal to $12,000. And by the way, this needs to be paid this month as it is given. And the first question would be, can you calculate the gross profit? Now here we begin to talk about the variety of profits. So we're going to talk about gross profit, we're going to talk about net profit, and we're going to talk about retained profit, and they're all different. So previously we said that, okay, profit, but there are actually at least 3 types of these profits. So the gross profit is a difference between the revenue, which you're familiar with, and the cost of goods sold, which is called себестоимость. So you've spent some amount of money to produce this particular product, for example, to manufacture this particular product. Okay, it's the cost of goods sold, it's себестоимость. Then the difference between this revenue and the cost of goods sold is equal to gross profit. Okay, so please note that the gross profit is a difference between revenue and the cost of goods sold. Hopefully you'll understand it clearly and neatly in the next slides, because we're going to show you in a neat and clear table how it's actually calculated. So no worries if you don't get it yet. Now the next question is, what is the cash? What is the net cash flow at the end of the month, and why A and B are different? Now you may actually suspect that they're going to be different because we are given that 50% was only paid and 50% wasn't paid yet. So in this month we actually don't have 45,000 in cash, but we just have 22.5 thousand of cash and a promise that the rest will be paid next month. So let's have a look. Now the gross profit, as we said before, this is going to be the difference between the revenue, which is $45,000, minus $12,000, which we need to pay to our suppliers already this month. So therefore the gross profit actually needs to be equal to $33,000. Now, is it the case with the cash? Do we really have $33,000 of cash in this month? It's actually not, because we know that we haven't been paid 100% yet. So we were only paid 22.5 thousand, and then minus 12,000 was paid in cash to suppliers, and therefore the cash at the end of the month is not actually equal to the gross profit. So you can see the difference, right? And the rest, $22.5 thousand, will be paid next month by your creditor, by your client, actually, in this case. And if you sum them up, if you sum this one to that one, then you will work out the gross profit. Now, the gross profit may or may not be equal to the cash, to the net cash. It will be equal to the net cash if you got paid in cash 100% and you did pay in cash to your supplier. In this case, the gross profit is going to be equal to your cash, the net cash. But if it's not, I mean, like in this case, it might be different. Okay. Good. Now, what is cash flow? Why do we need it? And what's the story with the cash flow? Well, the cash is needed to pay. The cash is the most liquid asset. A liquid asset, it flows like a liquid. Everyone wants it. Everyone is happy when you pay cash, and they will be more than happy to sell you anything for the cash. But you can't really buy anything, for example, using your equipment or using your product or using any other asset. So cash, why cash in business is so important, and even the cash statement, the cash flow statement, is a separate story, because cash is the most liquid asset. That's why it's so important. Cash is received from the customers, but also it can be loan, it can be sell, it can also be generated from different sources as sales of assets and sales of shares if you're a public limited company. Now, we also did figure out that cash flow is not always, it can be the same, but not always the same as the profit. Now, if there is a lack of cash, then you might actually have some problems. if you run out of cash, okay, then that means you may not be able to pay your liabilities. Liabilities обязательства. So you may not be able to pay to your suppliers, you may not be able to pay your rent, you may not be able to pay the salaries, and in this case, a lot of employees would be upset about that. The suppliers, again, would be upset about that. So you kind of have a risk of having a bad reputation and even go to bankruptcy if you do have a lack of cash. Now, so we figured out why is it so important to keep track of your cash, and why is it so important to have the cash. Now, you do need a forecast for your cash in future in order to avoid insolvency, so we call it bankruptcy. Now, some businesses, they may actually have some seasonality. For example, some businesses may have a bad season during the summertime, some businesses may have some bad season in the wintertime, and so on. So if you do know from historical data that you will actually have lower cash flowing into your business, then obviously you need to get a very good and solid understanding what to anticipate and what to expect in future. That is why the forecast for the cash flow is so much important, okay? Obviously, the cash flow forecast is needed when you do start a business, when you run the existing business, again, not to be short of cash. Even in an existing business, even if you have started your business, it doesn't mean that you shouldn't worry about your cash flow forecast at all, because even if you're running the business, you may actually have some problems in future because of this seasonality, for example. Managing the cash flow is also super important when you do borrow the money from the bank or investors. So both bank and both investors will actually want and demand for your future cash flow forecast so that they do have an understanding. And obviously, it's not just you telling them we're expecting this. You have to justify a lot of those numbers in your table. Otherwise, they won't just believe you. So you have to prove and justify. And guys, obviously, in your business plans, if you do notice in your business plan guidelines, we tell you that you need to justify your future cash flows. Okay? Now, the future cash flows, how to justify them, we're going to look at them shortly. Now, I'm going to give you an example. So there is a company called Good Hope Enterprise, and then they provided the future cash flow. So let's go one by one. Now, in January, the inflow was accounted to $35,000, and the outflow, the expenditure they've paid to the employees and other expenditures, was accounted $30,000. Now, the difference between this inflow and outflow is a net cash flow. Okay, so we need to be super crystal clear here that the difference between inflow and outflow needs to be positive. If it's positive, then you're okay. If it's negative, and usually in finance, negative is not given as a minus sign, but it's given in brackets. Okay, so if you do see brackets in a cash flow statement and income statement, that means it's negative. That's something that you want to avoid. Now, what is opening bank balance and what is closing bank balance? The opening bank balance is the amount of cash that you did have at the beginning of the month. Let's say it's $10,000 as it's given here. And then it's also known that you actually generated net $5,000 in cash. So therefore, at the end of the month, you'll end up with 10 plus 5,000, which is $15,000. And if you do notice, the opening balance of the next month will be your closing bank balance, which makes sense because, well, you ended up with $15,000 and so on. The February may not be so good as January because, as you can see, the outflow exceeds the inflow, and therefore you have a negative net cash flow, and even the closing bank balance would be minus $5,000. Is it possible? Well, theoretically, yes. Practically, no. The banks will not, well, unless you borrow the money from the bank, it can be overdraft, for example, or you borrow money from somebody, okay, then obviously you'll have to close this gap of $5,000. Now, from this table, you can understand how important the cash flow forecast is, because you may actually draft it like this, and then you say, okay, we expect that the February is not a good season for us. For example, if you're a retailer of clothing, it's historically not a very good one as well. You may actually see, we need to have extra $5,000 here because we anticipate that we're going to have lots of insolvency. We'll need a lot of need to a cash of minus $20,000. Okay, good. So I think we've already discussed in detail why do we need the cash flow forecast. In order to avoid the negative cash flow, in order to know how to manage your cash wisely, not to overspend it when it's good, when there is a good time. Obviously, the businesses have this appeal. They may have this problem of buying extra stuff or buying some unnecessary luxury things that they may not be able to afford in future when things go good. But if you do have a cash flow forecast, then you'll say, okay, I'm going to need to actually save a few million tenges just in case, because I know that it's very likely that I'm going to be short of cash in September. So you may actually save some money and manage the money so that you do not have any problems and do not have to borrow from somebody in September. And by the way, if you do borrow some money, you have to return the money, not exactly the same amount, but plus the interest rate, which is not good for you. Good. That's it, guys, for today. So hopefully it was clear. Now you may refer to our main source of information, which is textbook. Okay, go to this textbook, which is available on Moodle, and look at and refer to chapter 21 and 22. See you.